The Fed isn't worried about inflation, and that should frighten investors. Jerome Powell says our best view is that the effect on inflation will be neither particularly large or persistent. He just said that about 10 days ago. So let's see what Michael Arone says about this. He's a CFA with State Street. And man, how do I despise SSGA, State Street Global Advisors. Libs, big wokers, they're the ones that put that freaking girl in front of the bull in Wall Street. It just totally corrupted the dude's essentially intellectual property who built that bull. Was it that girl going like this? Oh, whole thing's nuts. I cannot. Corporate America just they suck. All right, so investors should be aware of the Ides of March. Federal Reserve policymakers have been trying to convince market participants that any uptick in inflation from massive fiscal and monetary stimulus will only be temporary, and that rising interest rates shouldn't be feared, but rather celebrated because they demonstrate investors' confidence that the economy will be booming this summer as COVID vaccinations rise and the pandemic fades. The mid-March FOMC is the Federal Open Market Committee meeting. Powell post-meeting press conference all just downplayed the risk of inflation. The officials did raise their 2021 median inflation forecast from 1.8 to 2.4 in March. Easy year-over-year comparisons are likely to result in greater measures of inflation, but that's more about the math than the economics. Despite the 2021 increase, the Fed's inflation forecast over the next couple of years has barely nudged higher. This underscores the Fed's expectation that inflation any pickup will be temporary. Last week, after a Fed meeting, Powell gave an encore performance. This time it was a duet with Janet Yellen. Both policymakers sang the similar tune, telling members of Congress not to worry about soaring inflation. Powell and Yellen are required to appear before the House Financial Services Committee about the CARES Act. All right, good. So far, the data on inflation is cooperating. On March 26th, the BEA, Bureau of Economic Analysis, PCE, personal consumption expenditures, rose just 1.4% over the last 12 months, and that figure was below consensus expectations. Interesting. Market participants are buying into the Federal Reserve's narrative about transitory inflation too. Investors' inflation expectations can be observed in the Treasury markets by calculating the difference between the yields on ordinary Treasuries and the yields on tips. And that's how you arrive at a break even. So you look at the yields on tips minus the yields on ordinary treasuries, that gives you break even. Not surprisingly, the economic recovery has pushed break even rates to their highest levels in more than a decade, implying that inflation is set to increase. However, short-term break even rates are now higher than long-term ones, leading to a rare inversion. Remember the inversion of the yield curve? Oh no! And then we had there wasn't enough liquidity in the repo market. Last year, about this time, I guess about a month before this last year, everyone's talking about the repo market. I was like, repossessing vehicles? I'd never even heard of the repo market. And all of a sudden, out of nowhere, everyone's like, the repo market. That's going to doom us. I wish people would just stop. You've never heard of the repo market until somehow last year it got into the mainstream media. And all of a sudden, you're like, the repo market, we're all going to die. Oh, my goodness, the repo market. I remember seeing the first article. I said, what the hell's a repo market? I always thought repos means repossessed vehicles. They just want to scare you because fear brings clicks. But what happens if the inflation watchdog has developed a blind spot? Here's rising inflation expectations have lifted 10-year yields and steepened the curve. All right, so here we go. U.S. break-even point. So was that 1 to 2, I guess? Is that what it looks like? I can't really tell. 10-year yield is right here, a nice jump. But again, look at this, man. It's just back to where it was before all this crap. This is right there is a temporary decline because the insanity of the flight to quality because of everyone's scared crapless about the coronavirus. So right back to where we were. And don't forget, even this right here looks high. That's only 3%, 10-year treasury at 3%. I remember I did a video on that, and I was wrong. I said, we'll never see low interest rates like this again. Inflationary powder keg. Extraordinary fiscal and monetary policies have stoked the inflation expectations. There's been more than a 4.2 trillion increase in the money supply over the past year. M2, a measure of monetary supply that includes currency, deposits, and shares in retail money market funds, climbed 27% in 2020. As more Americans get vaxxed and COVID-19 restrictions are rolled back, these elevated savings could be unleashed to create an inflationary boom as early as the summer. Well, wait a second. There has been an incredible 4.2 trillion increase in the money supply the past year. M2 is a measure of the monetary supply that includes the currency, deposits, and shares in retail money market funds. See where this guy's making a mistake? He's assuming that means it goes into people's wallets across the board as opposed to a few select. Well, this is what happens with inflation. A few select people get the benefits, not everybody. So he's saying because M2 is so high, that's going to lead to, in less restrictions, more people be getting their spending on. And if you just look at my man Richard Koo from what happened in Japan, that didn't happen there. Yeah, people just did not want to spend. There's like a boycott of expenditures and certainly boycott of borrowing. Already, companies have started to warn investors about the negative impacts on profit margins from supply chain bottlenecks, rising raw material costs, and high labor expenses. For the first time since July of 2019, the PPI, the Producer Price Index, is outpacing the CPI, highlighting the increasing pricing pressures that many businesses now face. For the first time since July of 2019, 18 months ago. The gap between the PPI and CPI also suggests that so far businesses are absorbing the higher costs instead of passing them to customers. This supports the Fed's claim that inflation will be transitory. However, the corporate execs determine that their increased costs are becoming more permanent. They will begin to pass them along to customers, making the spread between PPI and CPI a critical barometer for deciding whether high inflation is here to stay. So it might be easy for the Fed to dismiss rising prices as transient, but with aluminum, copper, oil, lumber, and housing all surging in recent months, it's risky for investors to ignore the possibility that this may be a more permanent move in upward shift prices. Right, exactly, man. I mean, it could easily be inflationary. We don't know. But the idea it will be inflationary is just stupid. We don't know that either. We don't know. No one knows nothing. When does temporary come in permanent? So the Fed isn't worried about inflation, and that should make investors nervous. Okay. How does the Fed know that price increases are fleeting, that they're not permanent, they're temporary? Corporations don't seem convinced that prices will decrease as production of raw materials increases. The Atlanta Fed March report showed that businesses' year-ahead inflation expectations jumped to 2.4%, the highest reading since the survey began in 2011. Why would that shock anybody? We just went through a freaking insane year of nothing. Why would it shock that we have a high expectations for inflation this year, given that we had literally nothing last year? It's just weird to me. Of course it's temporary. It could be permanent, sure. But we were going on freaking awesome. Then we fell off a cliff because of the insane reaction to coronavirus. And so we fell so much, we're just coming back that inherently it's going to be inflationary. Because we fell so much down. But we're still going right back to where we were. Again, we'll just look at this right here. Here we are right there, and there's where we were. The same thing with prices, inflation. I mean, everything fell, all right? We had a big freaking, ceiling pushed down on us, and whack-a-mole. And now we're saying, okay, now we can breathe some fresh air, we hope, and now we're going to say inflation is going to come. Well, of course it would, because we're so far down. So inflationary times from where we were last year only makes sense. Anyway, consumers all seem to be anticipating more prolonged price increases. Yeah, well, consumers, because they just read the media, man. This month, investors have been on edge regarding resurgent inflation. Have you been on edge? Rising inflation eats away at the interest bonds pay and cuts the present value of the company's future cash flows. The 10-year Treasury is near its highest level in 14 months, predating the pandemic. And the tech-heavy NASDAQ composite is roughly 6% below its all-time high reached in mid-February. Long-term, the higher inflation regime could upend what has worked well in investment portfolios over the past, specifically long-maturity bonds and growth stocks. All right, well, that might be the stupidest article. Sure, the Fed could be correct. Maybe inflation will be temporary. However, not preparing for the possibility that the Fed could be wrong seems incredibly risky. To guard against the possibility of rising inflation, investors should consider replacing traditional bonds and growth stocks with growth-sensitive bonds and rate-sensitive stocks. That was not a very good article, but yeah. I will see. We shall see. But If you got thoughts, let me know. That was not a good article. I will see you.